What's up, yo? Hey guys, welcome back to the channel. Thanks so much for joining me today. Today's video is all about investing. This is philosophy. So this is Investing 101 for beginners, specifically in Canada. All of the items that I'm going to be discussing relate specifically to the Canadian side of the investing world. We're going to go through different kinds of accounts, different things to invest in, and just some of my own personal tips. Just a disclaimer, I am not a professional accountant. I am not giving this advice as professional financial advice because I am not a financial professional. This is for entertainment purposes and also just my own experience with investing and the things that I think will help you get along your path to FIRE. So let's do a little overview between the two main investment accounts that are tax sheltered in some way in Canada. First, we have the RRSP, which is the Registered Retirement Savings Plan. Next up is the TFSA, which is your tax-free savings account. Really, this should be called a tax-free investment account because I think a lot of people get that mixed up. It is really meant for investing. My first tip is to always make sure that you're getting your RRSP match at work. Make sure you read through your documents that go through your RRSP, what percentage the company matches, and make sure to watch out for what percentage of that percent the company matches. Some companies will match 5%, but only 50%. So that means you have to double your contribution in order to get that full 4% match. Other companies will match, say, 2%, but 100% of contribution. So every $100, they're gonna match 100, as opposed to if they did a 50% match, where if you put in 100, they'll put in $50. So that is something to definitely watch out for, but make sure at the very minimum that you are getting your full work match, because the money that your company puts into that account is free money for you. There is also something called a vesting period. This is something to look out for when you're getting your work match and going through all those documents. A vesting period is how long you have to wait until the money is vested, meaning that if you leave the company within that time frame or before that vesting period is met, they can take the contributions that they put into that account back out. So a lot of companies don't have a vesting period, but some have 1 to 3 years. This is an incentive for you to stay with that company for a longer period of time so that you don't miss out on those contributions that the company made. So I would highly recommend that you talk to your HR representative or somebody who deals with your workplace RRSP matching program. Go through all of the paperwork and make sure that you have a clear understanding of how much money you have to put in and at what point does that money actually become yours. So for a tax-free savings account or a TFSA, I recommend to most people that they go ahead and max that account first after getting their maximum work match. Especially if you're making under around $80,000 or $70,000 a year, it's way more beneficial in terms of tax benefits to put all of your money into your TFSA up to the max amount, which I believe is around $80,000 if you've never put money into it. So work on maxing that first and then go into putting more money into your RRSPs. Of course, if you make a higher salary, over $80,000 or $70,000, it might be more beneficial for you to put money right into your RRSPs instead of putting it into a TFSA. And every year you do have a cap on how much money you can put into an RRSP, and usually you will see that information on your latest tax assessment. It will determine how much money you can put into the RRSP. Money is added to that max amount every year based on how much you made the previous year. Just to break down the differences between these two accounts, an RRSP is tax deferred, meaning that any contributions you make now, you can deduct that amount from your overall income for that year. So if you made $80,000, but you put $20,000 into your RRSPs, you can deduct that $20,000 contribution, meaning that you're only paying taxes on $60,000 of income for that year. It doesn't mean that the contributions are tax-free, however. When you go and take money out of your RRSP in the future or in retirement, then you will pay tax at that time. So it is dependent upon how much money you're taking out in retirement. That will dictate how much in taxes you're going to pay on that amount that you put in many, many years ago. A TFSA, on the other hand, is completely tax-free. So you can put as much money as you can up until that max amount into the TFSA and invest it in whatever you want in that account. I don't think you can put money into crypto in a TFSA or in an RRSP. Correct me if I'm wrong in the comments below. But I believe in Canada, cryptocurrency, you cannot have a tax sheltered account funding that. So you can invest in whatever else. You can invest in index funds or ETFs, which is what I recommend, GICs, stocks, whatever you want to do. Any gains that you realize within the TFSA is going to be tax-free. This is a huge benefit, especially if you hit the lottery on a stock. If you buy a stock and it just skyrockets, you don't have to pay any additional tax on that capital gains or on those gains. Pretty cool. And like I said before, an RRSP does increase its limit every year depending on how much you made the previous year. Likewise, a TFSA, the government adds a certain amount, a certain dollar amount to the max amount every single year. Usually it's around $6,000, $5,000. I think there was one year it was $10,000. So what I like to do when I had previously maxed my TFSA is every year, the first couple of months, I would just throw in however much that extra amount was and invest it right away into some index funds, the TDE series, mutual funds, and make sure that I'm getting the longest time frame for my investments. So now that we've covered some of the basics surrounding an RRSP and a TFSA, let's go ahead and go into how you actually start investing with these accounts and what types of things you should be investing in. A resource that I really like to use is the Canadian Couch Potato, and he has a few different model portfolios on his blog through different banks that walk you through what you might be interested in investing in depending on your risk level. I also recently found out that the founder of the Canadian Couch Potato wrote a book about investing, and I have it on hold at my local library, so I will be picking that up and reading through it, and I'll let you guys know what I think of that book once I've read it. But there are a lot of resources out there. I just think the Canadian Couch Potato is a really good place for Canadians to get a grasp on what is the best for investing. Personally, I bank with TD, and I have my TD direct investing account all on my phone. So every major bank will have some kind of direct investing or investing app that you can access through your normal bank account. I actually really do enjoy the TD platform. I think it's really easy to use. It looks nice. It's very easy to buy and sell stocks and index funds and everything on the phone. I do use it on my desktop sometimes, but this is a good option if you don't want to go and open an account with something like Wealthsimple or Questrade and do the whole thing of like moving your accounts to different banks. I have been in the mind space of considering that, but I think if you're just starting out, opening an investing account with the bank that you already bank with is a good stepping stone when you're just starting to learn this stuff. So now what to invest in. When I started investing, I really didn't know what I was doing, and I was reading a few things here and there about what people recommended, but most of the content was relating to people in the United States. And a lot of the investments and the ways that they invest, the accounts they invest in, are just not relevant to the Canadian space. I decided to pick up a few books from my local library, start reading about it. I read a bunch of posts on the Canadian Couch Potato, and I just went through the internet, searching Reddit and places that are similar to find out where I need to start and what should I do. At the time, I was toying with buying property, which is a really big investment, so I needed access to a lot of my net worth, potentially within a year or two. This is why I decided to invest in GICs. These are guaranteed income certificates, and it means that you are guaranteed a certain rate of return over a very specific period of time. Most of the ones that I chose to invest in had a return of about 2% over the course of, I think, 14 months. It wasn't the best, wasn't the greatest rate of return, but at least I knew that my principal amount, the money that I put into that, was guaranteed. So I ended up making, I think, around a few $1,000s by doing that, which, whatever. I mean, it's a good way to get started if you're very risk averse and you're not really sure if you want to take a big risk and buy like certain individual stocks, or you don't really understand what index funds or ETFs are yet, so you just want to sort of dip your toe in the water, a GIC is a good way to get started. They're really great too if you need a large sum of money within a short period of time, because you don't want to have to rely on the market if you need that money very soon. And when I say very soon, I want to say that's in between like 1 to 3 years. If you need that money in that time frame, I don't suggest that you put it into the market. I'm sure a lot of people feel differently, but for me, if I need like $50,000, $60,000 for a down payment within the next 1 to 3 years, I'm not going to put that or risk losing any of that principal in the market, because I don't have the time frame to make up for it. If I have to sell in a dip, I'm just going to lose that money totally. So I started with GICs, and then I slowly moved into investing in index funds. And the ones that I chose to go with were the TDE series line. These were the investments recommended by the Canadian Couch Potato and a lot of other resources in the Canadian investing space. So these are super low cost, and they're very easy to order just through the TD app on the phone. And there were 4 different ones when I started investing. One was an international index fund, one was US, one was Canadian, and then the other one was a bond. I decided to get rid of the bond structure, and I just invested in the 3 international, Canadian, and US markets. This is because I just wasn't feeling as risk averse as I did in the past, and I wanted to make more money. I mean, I don't plan on retiring until like 30 years from now, so I have a long line to fight off any kinds of dips, because over time the market will always trend upwards despite any kind of dips along the way. Index funds trade like mutual funds. What that means is when you go to buy an index fund, that you can pick a dollar amount instead of how many shares you want. And an ETF or an exchange traded fund trades in that way. So an index fund, you can dollar cost average, which is where you just put whatever amount you can every month into each stock. So if you have $100, you want to split it into those 3 different categories. Just put 100 divided by 3 into each one, and you won't have any issues with having to pay like a trading fee. It just gets put directly in at that dollar amount. So you have like decimal points or portions, fractions of shares. I hope you guys are keeping up with this. I'm not too sure if what I'm talking about sounds really confusing or not, but I'm gonna try and do like a screenshot of what it looks like on my phone. So you pretty much log in on the TD app anyway. You log into your account, and then you go into the investing area. Click on your TFSA that's in your TD Direct Investing account. Click on that. It'll bring you to the web broker area. There, they'll have some options at the top that says like buy and sell. So you click on the buy option. There should be a drop down which lets you pick between like stocks, mutual funds, and I think there might be a couple other things in there. But anyway, so you pick mutual funds, and then you can research or look up the code. So the codes that I invest in currently are TDB 900, TDB 902, and TDB 911. So you pretty much just type in that code, it'll come up, you put in how much you want to buy $100 worth, okay, and then you select send order. And over, I think about a day to 3 days, that order will be filled, and that's pretty much it. Another low-cost option for investing are ETFs or exchange traded funds. These trade like individual stocks, meaning that you have to buy a certain amount of stocks and figure out how much money it's gonna cost based on the price that it is at that time. And a lot of the times, a lot of platforms will charge a trading fee. Buy ETFs because that is the same way that stocks are traded. If you're buying individual stocks, you're gonna have to pay about $10 every time that you wanna purchase stock. So this is a detractor for me, although I've heard that there are many platforms out there like Wealthsimple and Questrade that waive that fee. So that is definitely a bonus to look into opening an account outside of like a major bank in order to trade that kind of thing. For me, index funds just are more hands-off, and I much prefer that. Both ETFs and index funds trade an entire market, something like the S&P 500. So instead of trading individual stocks and seeing them go up and down, you're gonna trade a large group of stocks like the S&P 500, and if they're all trending up, you'll trend up. If they're trending down, it'll trend down. So you don't have to worry about 1 or 2 stocks going up and down like crazy all the time. You're just watching the entire market go up and down over the course of however long it is until you retire. Because the investments that I'm currently talking about, these are long-term investments. These are investments that you're gonna have for like 20 to 40 or whatever, however many years. These are not meant to be taken out within a few years. They're not gonna double, triple, or make you a ton of money like it would be if you picked a stock and hit the lottery and made a bunch of money, or crypto. Those are more on the side of gambling investing. That's what I refer to that as, where it's really not predictable. You don't know when those gains are going to come, or potentially if you're gonna lose a lot of money. I currently have one single stock that I put about $4,700 into, and it pretty well bottomed out, and I've lost the majority of the money that I put into it. So that is gambling. When you put money into a single stock, and it goes way down, it's just like going to a casino and putting $100 on the table and losing. It's just not consistent, and it's not the best way to ensure you have a solid future. I have no problem with buying individual stocks and people doing that, but just be sure that the money that you're putting into individual stocks is money that you're willing to lose, because that is a very real risk. If you're investing in something like ETFs or index funds that trade a market, the long course of investing, you're pretty much guaranteed to trend upwards and average about a 5% return over time. My current uptick, if you want to call it that, or my current rate of return on my TDE series funds is about 28% over the last 2 years. So I know that it goes up and down, and I'm not expecting returns like that over the long term. It's a lot less risky to invest in something like that, and the amount of work you have to do is pretty low. So every year I like to rebalance my account, and that means that when I log in, I can see the 3 different index funds that I have and how much of my portfolio is invested in each. And I want a 3 split. So I want it to be about 33% per each index fund. And at the end of the year, usually one does a lot better than the other. So to rebalance, what you have to do is sell some of the one that's doing really well, buy some of the one that's not doing so well, so you can even it out again, and everything goes back to 33% or so. Depending on how you want to split it up, if you have bonds, you can divide it by 4. But this is a very easy method to just put money in, dollar cost average by putting however much you can into each of these investments every month, and then rebalancing once a year to make sure that you're maintaining that percentage that you want, that breakdown. So just to recap everything that we've talked about today, number 1 is to make sure that you are getting your maximum match for your RRSP at work. Number 2 is to max your TFSA if you have a lower salary, something under $70,000 to $80,000 a year. Number 3 is to then match your RRSP, or you can start with the RRSP if you're making a higher salary and then move to your TFSA once you've maxed your RRSP. Number 4 is to make sure that you're investing in low-cost options like index funds or exchange-traded funds. This will allow you to really set it and forget it, and to ensure that you're eliminating any kind of major risk that would be associated with buying individual stocks. My 5th tip is to only put money into individual stocks that you're willing to lose. You don't want to put your life savings into an individual stock because it could bottom out at any point in time. So I hope you guys enjoyed this video. Thank you so much for joining me today. If you have any further questions, leave me a comment down below. I would love to hear from you, and I'll see you in the next video. Bye.